Level 1. A man walks into a bank carrying a suitcase full of cash and asks to open an account. That is not money laundering, that is a confession. Money laundering is all the work that happens so that moment never has to occur. The work of taking money that came from something illegal and building it a story, a paper trail, a reason to exist. And the very first level of that work is the oldest trick there is. You buy a business that already touches cash all day long. A car wash, a restaurant, a vending machine route. Nobody knows how many customers walked through the door yesterday except you. So you say 400 came. 200 actually did. The other 200 were criminal proceeds, and now they are revenue. And revenue is legal. It is elegant, it is nearly invisible, and it has exactly one weakness, the one that destroyed the most famous criminal in American history. You have probably heard that the phrase money laundering comes from Al Capone's laundromats. It is a wonderful story, and there is very little evidence for it. Etymologists generally trace the term to the 1970s, decades after Capone was in the ground. But the underlying method was absolutely real, and Capone's Chicago operation ran exactly this way, legitimate cash-heavy fronts absorbing the profits of an illegal empire. What is remarkable is what finally brought him down. Not a witness, not a raid. In October 1931, Capone was convicted of tax evasion and sentenced to 11 years, after Treasury investigators spent years reconstructing his income from ledgers, receipts, and bank records. The man who ordered killings was undone by bookkeeping, and that is the flaw baked into Level 1. A business can only credibly absorb so much. A restaurant that suddenly earns $20 million a year is not a restaurant, it is a signal. So what do you do when the money outgrows the front? Level 2. You stop moving it in one piece. If a large deposit attracts attention, the intuitive answer is to make many small ones instead. In the trade, this is called structuring, or smurfing. Money broken into fragments and fed into the system across many accounts, many people, many days, each piece individually unremarkable. It is intuitive enough that virtually every criminal organization has tried it, and that is precisely why it fails. Regulators saw it coming half a century ago. The United States passed the Bank Secrecy Act in 1970, requiring banks to report large cash transactions. Then, in 1986, the Money Laundering Control Act made deliberately breaking up deposits to dodge those reports a federal crime in its own right. Read that again because it is the part people miss. Structuring is illegal regardless of where the money came from. You can be convicted for how you moved clean money.
The system that catches structuring is not a person watching a screen. It is pattern detection, and human beings are catastrophically bad at looking random. In 2015, one of the most powerful politicians in the United States discovered this. Dennis Hastert, former Speaker of the House of Representatives, for years second in line to the presidency, was indicted after his own bank flagged a pattern in his withdrawals. He had been taking out cash in amounts arranged to stay beneath the reporting threshold. The money was his. The bank noticed anyway. Hastert pleaded guilty to a structuring charge and was sentenced to 15 months. The lesson of Level 2 is brutal, and it scales all the way up. The more carefully you shape your transactions to look ordinary, the more distinctly they stand out to a machine that has seen a billion ordinary transactions. So the money has to stop being cash entirely. It has to become something that does not need to be carried. Level 3. The money stops being money and becomes paperwork. Here, you are no longer hiding cash, you are hiding ownership. A company is registered in a jurisdiction with light disclosure rules. That company is owned by another company. That one is owned by a foundation, whose named director is a professional nominee. A real person paid a modest annual fee who sits on hundreds of boards and knows nothing about any of them. Nothing about any single step is illegal. Shell companies have entirely legitimate uses in mergers, asset holding, and joint ventures. But stacked deep enough in the right sequence of jurisdictions, the structure produces something powerful. An asset that legally belongs to no identifiable human being. Investigators call this the layering stage, and layering is not about hiding the money, which sits in plain view. It is about exhausting anyone who tries to trace it, because every link in the chain requires a separate legal request in a separate country under separate law. For decades, this level was effectively impregnable, and then in April 2016 it broke open, not through investigation, but through a leak. 11.5 million documents belonging to a single Panamanian law firm, Mossack Fonseca, were handed to journalists and became the Panama Papers. Inside were more than 200,000 offshore entities and the identities behind them. The fallout was immediate. Iceland's prime minister resigned within days. Investigations opened across dozens of countries, and by 2018, Mossack Fonseca itself had shut down. Note carefully what happened there. The structures worked. They survived audits, regulators, and journalists for decades. They died because somebody with access copied the files. Which raises the question that defines the next level. What if the money never has to sit still in a structure at all? What if it moves continuously, disguised as ordinary business?
Level 4. You hide the money inside real trade. This is where laundering stops looking like crime and starts looking like the global economy. Because it is the global economy. Every day, tens of millions of invoices cross borders for goods whose value nobody can independently verify. What is a container of scrap metal worth? A consignment of textiles? A shipment of electronics components? There is no objective answer, only a number written on a piece of paper. And if a buyer in one country and a seller in another are secretly the same person, that number can be anything they want it to be. Overstate the invoice and money moves legitimately from one country to another. Understate it and value moves the other way. No cash crosses any border. The paperwork is complete, the customs declarations are filed, and the transaction is, on its face, entirely real. Financial crime investigators consider trade-based laundering one of the largest and least policed channels in the world precisely because catching it means proving that a price was wrong. The financial markets version of this same idea produced one of the great scandals of the last decade. Between 2011 and 2015, clients used Deutsche Bank to run what became known as mirror trades, shares bought in Moscow using rubles, and an identical quantity of the same shares sold almost simultaneously in London for dollars, with the buyer and the seller ultimately being the same beneficial owner. No profit was intended. The trade was the product. Roughly $10 billion left Russia this way. In January 2017, regulators in New York and London fined Deutsche Bank around $425 million and £163 million, respectively, for the control failures that allowed it. And here is what actually exposed the scheme. The two halves matched too perfectly. Real markets are messy. These trades were symmetrical, and the symmetry was the signature, which forces the obvious escalation. What happens when the bank is not a bystander that failed to look, but the machine itself? Level 5. The bank stops being an obstacle. At this level, you are not sneaking past compliance. Compliance is the door being held open. This is not hypothetical and it is not rare, and the numbers involved stop making intuitive sense. In 2012, HSBC agreed to a settlement of roughly $1.9 billion after United States investigators found that its control failures had allowed hundreds of millions of dollars connected to Mexican drug cartels to enter the financial system. A Senate investigation documented that some Mexican branches had physically widened their teller windows to accommodate the standardized cash boxes customers were bringing in. Sit with that detail. The architecture of the building had been modified to accept the volume.
But the largest case in European history makes even that look modest. Danske Bank, Denmark's biggest lender, operated a single branch in Tallinn, Estonia. Between 2007 and 2015, that one branch processed roughly 200 billion euros in transactions for non-resident customers, many of them Russian and post-Soviet nationals, with around $160 billion of it routed through American banks. A branch holding a tiny fraction of the bank's assets was generating an extraordinary share of its profits, and that anomaly was visible in the bank's own internal numbers for years. An internal whistleblower's warning that the branch might be knowingly dealing with criminals reached board-level discussion in 2014. In December 2022, Danske Bank pleaded guilty in a U.S. court and agreed to forfeit approximately $2.06 billion. And notice what it actually pleaded guilty to. Not laundering, but conspiracy to commit bank fraud, for lying to the American banks that gave it access to the dollar. The system did not catch the money, it caught the lie told to protect the money. So what if you could remove the banks from the equation altogether? Level 6. The money leaves the banking system entirely. This was the promise of digital currency, and for a while it looked real. Value that moves peer-to-peer, across borders, without any institution's permission. No compliance department, no correspondent bank, no teller window to widen. Early on, purpose-built operations tested exactly this. Liberty Reserve, a digital currency service, was shut down by American authorities in 2013 after being accused of processing around $6 billion in criminal proceeds. Its founder was later sentenced to 20 years. But the deeper story of this level is not that digital money failed. It is that it produced the single most damaging piece of evidence in the history of financial crime, a permanent, public, universally readable record of every transaction ever made. In August 2016, a hacker stole 119,754 Bitcoin from the exchange Bitfinex, worth roughly $70 million at the time. For years, the funds were moved through a genuine maze: false identities, automated transactions, layers of exchanges and darknet markets, conversions between different cryptocurrencies, mixing services, and eventually gold coins. Some of it was even spent on a Walmart gift card. It was, by any measure, sophisticated laundering. It was also all written down. In February 2022, investigators seized roughly 95,000 of those Bitcoin, then worth about $3.6 billion, at that point the largest financial seizure in United States history.
Ilya Lichtenstein and Heather Morgan pleaded guilty to money laundering conspiracy in August 2023. Lichtenstein was sentenced to 5 years in November 2024. 6 years of careful layering, unraveled by a ledger that never forgets and never dies, which leaves exactly one level above this, the one where you do not need to hide from the state because you are the state.
Level 7. The country is the laundromat. At the highest level, money laundering stops being a crime committed against a financial system and becomes something a financial system is built to perform. In 1991, regulators in multiple countries simultaneously shut down the Bank of Credit and Commerce International, an institution that had grown to operate in dozens of countries and collapsed owing billions, and which investigators concluded had been structured across jurisdictions specifically so that no single regulator could ever see the whole picture. It was not a bank that was used for laundering. It was a bank whose architecture was laundering. And then there is 1MDB, which is the level in its purest form, a Malaysian sovereign wealth fund created to develop the national economy, from which an estimated $4.5 billion was misappropriated. The money bought a superyacht, paintings, jewelry, and property across several continents. It also, with a symmetry no writer would dare invent, helped finance the production of The Wolf of Wall Street, a film about financial crime, funded with the proceeds of financial crime. Goldman Sachs, which had arranged bond sales for the fund, agreed in 2020 to pay about $2.9 billion to United States authorities and separately settled with Malaysia. Najib Razak, the sitting prime minister, was convicted in 2020 and sentenced to 12 years. The financier at the center of it all remains a fugitive. There is no level above this one. This is as far as the ladder goes, because past this point, there is no larger institution left to hide inside. And when you look back down all 7 rungs, the same thing is standing at the bottom of every single one. Capone was destroyed by ledgers. Hastert was flagged by his own bank's pattern detection. The offshore structures died to a copied hard drive. The mirror trades were exposed by their own perfect symmetry. Danske Bank was convicted for a lie it told in writing. The Bitcoin was recovered from a public record that cannot be deleted. Every level of this ladder is a more expensive, more sophisticated, more international attempt to solve one problem, and every level fails for the same reason. Money leaves a trail. It cannot move without being recorded somewhere by someone, and the more of it you move, the more places it gets written down. The entire history of money laundering is the history of people spending fortunes trying to make money silent, and money has never once been silent.